If you have been researching trading related topics for some time, it's very likely that you've heard the statistic that 90% of traders or even more fail in trading and lose money. According to the same statistics, only some 10% of all traders make money consistently, while a 10% break even. While the exact number may not be completely correct, it may even be so that an even larger share of traders lose money. The fact remains that nearly all traders fail long term. The biggest reason why traders fail usually are the lack an edge and don't have a trading plan. However, there are several more reasons that could play either a big or small role in determining the failure rate of traders. Some of these include psychological aspects as well as poor money management. In this video, we'll look at the biggest reasons why traders fail and what you can do to increase chances of becoming a profitable trader. You'll also discover what trading style you should choose to maximize your chances of not falling into the losing category. Let's begin. Reason 1. Not having a trading plan. Trading is an endeavor that requires a long-term outlook and a solid action plan. It's necessary that you know in advance you're going to trade, when you're going to trade, and what you're going to trade. Otherwise, you won't have a general direction and will find yourself switching methodology, market, and strategy all the time, which will have a devastating effect on your trading performance. In trading, consistency is the key success provided that your methodology works. Here are some of the things you should clear in your trading plan before placing any trades. What type of trading concepts should you focus on? Are you going for a trend following or mean reversion approach or something less common trading style? It's essential that you decide this first since you'll benefit a lot from learning the trading styles one at a time. What time frame are you going to trade? Different market time frames vary a lot in terms of characteristics and trading performance. As a new trader, you'll be better off learning to trade one time frame than jumping from one time frame to another. The best time frame to start with, according to us, is the daily time frame. What securities are you going to trade? Most people start trading stocks, and although all stocks may seem the same, there are some important differences you should be aware of. The most significant difference is perhaps that between regular stocks and penny stocks, where the latter should be avoided. You may read more about penny stocks and associated dangers in other videos. Now, a trading plan is good to have, but it's worthless if you don't have an edge. Reason 2. Not having an edge. According to us, this is the single biggest reason why most traders fail. In order to be a successful trader, you must have some sort of advantage in the market. You must now know that after you enter trade, it's more probable that the market goes in your direction than the opposite. While this might seem obvious, it's actually not. Many traders are unaware that the strategies they use to trade their money don't have an edge or real advantage in the market. The fact is, most technical analysis out there doesn't work in its pure form, but must be massaged and tweaked into something that goes well with your particular market. Most market movements are random and cannot be used for any meaningful analysis. As a trader, your goal is to separate the wheat from the chaff to find those trading strategies that work. If you want to know more about the process of building strategies, please see other videos on this channel. Reason 3. Being undisciplined. For those traders who do have a real edge, this is one of the most common reasons behind trading failures. It's all very simple. You need to take the trades that are signaled by your trading strategy, regardless of what you believe about the current market conditions and where are you with your trading. This may indeed be very hard, and many traders, including ourselves, struggle with this sometimes. It's tempting to take an extra trade or perhaps skip some trades that don't seem that promising. However, the one thing you should be concerned with as a trader is to stay away from your own trading strategy rules. The edge doesn't lie in discretionary decisions, but in the proven framework, which is your trading strategy. The point at which most people struggle with adhering to their set of rules is when they're in a drawdown. Following the rules of a trading strategy might be easy as you're making new equity highs. However, the story shifts completely when you're finding yourself in a deep drawdown that starts to have its mental toll on you. Reason 4. Too big position size. So insinuate that you have a trading strategy with an edge and stamina to take all the trades. It signals now nothing could go wrong, right? Well, it's not that simple. Even a trader who has been working strategy and manages to place all the trades right could become a losing trader if his size his trades too heavily and gets wipes out doing a streak of losing trades. To make this clearer, let's say that you're a trading strategy and risking 2% of your capital on each trade. This means you could be in a 20% drawdown if you got a losing streak of 10 trades. This is perfectly manageable and represents a sensible risk level. Now instead, imagine you risk 10% on each trade. In this case, the same losing streak would have wiped out completely. One of the biggest challenges that we face traders is to strike a balance between risk and return. On the one hand, if you risk too much, you might be wiped out completely. On the other hand, if you risk too little, your returns won't be worth the effort. Reason 5, random reinforcement. Random reinforcement is something that we experience not only in trading, but in most areas of life. In short, it means that we attribute a certain outcome to proficiency or lack of proficiency, where the outcome might only have been the result of sheer luck and nothing else. In trading, random reinforcement can result in habits that build up over long periods of time, which are very hard to break. The traders that are hurt most by random reinforcement markets generally are those who act on intuition. Those traders will inevitably get a few winning streaks despite their lack of an edge and will ascribe to their success to intuition. As a result, many will start to risk more on each trade to make more money, which only will make them incur more losses as their random winning streak comes to an end. While random reinforcements may be the most noticeable among newcomers to the market, it's important to recognize that even experienced traders fall for this mistake from time to time. Even those with profitable trading systems will experience losing streaks from time to time, and during those periods, you need to realize that a good trade isn't one that ended with a profit. Instead, it's one that was carried out in accordance with your set strategy rules. Reason 6, not recognizing that market changes. Many new traders believe that if you only find one strategy that works for them, then they'll be set for the rest of their trading career. The thing is, no trading strategy will survive forever. Markets constantly change, and as your strategies fall out of sync with the markets, you'll have to abandon old concepts that don't work that well anymore. This only means that you must be ready to replace those strategies that stop working, not to be left with nothing to trade. Another critical thing to keep in mind is that you need to know when to switch a trading strategy off in order to cut your losses early. We recommend that you use a trading journal and log to your trades so that you may identify strategies that start to degrade significantly and might have to be switched off. This nicely brings us to the next point on the list, which is not keeping a trading journal. Reason 7, not keeping a trading journal. Although you might not recognize it as a beginning to trade, keeping a trader journal is essential to the success of a trader. Having things like your mistakes, trading performance, and other trading related metrics easily accessible is essential to be able to identify areas for improvement. Here are some of the things you should consider including in a trading journal. Date, name of security, number of shares, total investment, descriptions of trading signals, descriptions of entry and exit signals, stops used and reason behind them, total gain loss from the trade. Reason 8, having unrealistic expectations. The internet is littered with fake trading gurus who tell you the returns of several 100% or even 1,000% on an annual basis are possible and easy to achieve. Now, while we understand that it's tempting to fall for these kinds of statements, achieving these kinds of returns on a consistent basis is not possible, even for the best traders out there. This means that some traders who actually are successful don't understand that the returns are great, and as a result, they quit a profitable trading venture. Reason 9, not coping with psychological pressure. At first glance, trading may seem like an easy way to make money. You simply build a trading strategy and then execute the signals that it provides, and before you know it, you've made money. The above reasoning may hold correct during those times that everything goes well and your account just surges day by day. In such scenarios, trading indeed is a joy and everything feels wonderful. Failing as a trader in the sense that you don't take the trades that your strategy signals is not an issue. On the contrary, you'll have to exert self-control not to become overconfident and start inflating your position size. Now, things are not nearly as easy as when you're in deep and prolonged drawdown. that never seems to end. Even though most people understand on a rational level that drawdowns are inevitable and part of trading, it's not uncommon to see people start behaving irrationally in futile attempt to recover or prevent losses. For instance, it's common to see that some people don't take the trades that their strategy signal since they believe they too will end in losses. Attempt to take trades that are not signaled by their trading strategy. Let losing trades run since they believe that the market will turn around if it's just given some more time. Cut winning trades too soon in order to lock in profits and at least make some money. All 4 points above will have nothing but adverse effects on trading performance, and while you might say that you never would make those mistakes yourself, it's hard not to when you're experiencing a deep drawdown yourself. Again, one of the best ways of remaining calm and focused during a significant drawdown is to keep a trading journal. Reason 10. Not putting in the hard work that's required. Too many traders believe that trading is easy and that money can be made instantly in the markets. As a result, trading has come to attract far too many venture seekers who just want the money without the hard work. Creating a trading plan strategy worth trading has a chance of lasting and going forward takes many failed attempts and countless hours spent by the computer. We know this from first-hand experience which we have designed and trading our own strategies for many years. When we are teaching other people, the difference between those who succeed and those who don't is that some work harder than others. Remember, as traders, we're always competing with everybody else who has access to the same charting platforms and technology as we have. Thus, to have some chance of winning the game, we simply need to work harder. The best way to avoid becoming a loser trader. Having covered 10 reasons why most traders fail, we wanted to give some advice as how you can avoid ending up as a losing trader. Although there are many factors involved, we think there are a few tips that we have substantial impact on your chances of becoming a profitable trader. Avoid day trading. We know that day trading is most newcomers to the markets prefer to focus on. The promise of quick riches and fast-paced, exciting trading action attracts a lot of people who want to take trading to their full-time career. However, what is not mentioned as often is day trading is one of the most hardest trading forms to master. In the stock market, most of the returns that we get over long periods of time don't happen during the day, but in the form of overnight gaps. This is one of the reasons why day trading is much harder than other trading forms like swing trading, where you're helped by positive gaps that occur during the night. So if you're new to trading, we really recommend that you go with a trading form that's easier, such as swing trading. This will drastically increase your chances of making money in the market as the time it doesn't require nearly as much as your valuable time. Work hard. This is quite obvious but worth repeating again and again. Here at Insight, we're not successful because we have some sort of unfair advantage, although experience and knowledge we have today are the result of many years of hard work. When things don't go your way, be analytical and try to determine the root of the issue. You'll learn so much from this, and although it's incredibly frustrating, it will pay off in the long term. So many people make trading seem easy, and not knowing that their view of it isn't true and can become very limiting in the terms of hard work they're willing to put in. After all, who wants to work hard when everybody else seems to make money with the close to no effort at all? Conclusion: we hope this video covering the 10 reasons why Trader Trail has provided not only insight into the main reasons that lead to trading failure, but also what you can do to maximize your chances of success. For those of you who want to see more videos about how to become a successful trader, we recommend subscribing and liking this video. You know the catchphrase: study it, analyze it, adapt it. Peace.